On DKB's webcast on tax reform, a guide to understanding the Tax Cuts and Jobs Act. I am Kevin Woodworth, a manager in the personal tax practice. I primarily focus on high net worth individuals as well as small businesses. And here with me today is Morgan Hopkins.
I am Morgan Hopkins. I'm a manager in the business tax practice here at DKB. I specialize in the real estate, medical, and professional service organizations. And I do pretty much every kind of business tax return you can think of.
So today we're going to kind of break things up into two different components, the individual side of the tax reform and the business side. So I'm going to be focusing on the individual side. And as you can see here, we're going to touch on a number of topics, including the tax rates, deductions, and some estate planning as well. So the first thing I want to mention today is the tax rates. So what's happening with individual tax rates? And as you can see here, there's still going to be the same number of brackets as there was, 7. There was talk about maybe trying to simplify that to 3, but in the end, there's still 7, but the rates are decreasing. So the highest rate now is going to be 37% as opposed to the old highest rate of 39.6. And the other thing that I want to emphasize here is the widening of the tax brackets. So for example, if you look at the 24% bracket, that goes all the way up to $315,000. So there's going to be a lot of taxpayers that will save money. There will be taxpayers that might have to pay more money with this bill. It's all on a specific individual basis. And then on the next slide as well, this is just the single rates. So again, same brackets, different thresholds for a single taxpayer, wider brackets though still. And then this is just a comparison of 2017 versus 2018. A nice little chart to kind of show you where your income is, where you were in 17, and where you are going to be in 18. Another thing I want to mention is inflation. So in the past, the way that inflation was measured was what's called the Consumer Price Index. And going forward, they're going to be using what's called the Chained Consumer Price Index. So essentially what that means is it's a less generous measure. So over time, you'll see less adjustments for inflation. So what could actually happen is paying more tax down the road because of this inflation adjustment. So now into some of the deductions. The big one that I'm sure a lot of you have heard is the doubling of the standard deduction. And for married taxpayers, that's going to be $24,000 going forward. And kind of the idea behind this was we'll make tax returns simpler, we'll increase the standard deduction, more people will claim it, make returns easier. We'll wait and see if that's actually the case, because there's going to be obviously plenty of people that will still itemize, but there could be planning opportunities around this with the increase in the standard deduction, with timing of deductions and certain things. So much to be determined there. So now I'll dive a little bit into the itemized deductions, and there's a fair amount of deductions that are going away, but the ones that are going to be sticking around, for one, are going to be mortgage interest. So that one, there are a few changes. In the past, you used to be able to deduct mortgage interest on mortgages up to $1 million. And now that new limitation is going to be $750,000. Having said that, if you had an existing mortgage, you would still have the $1 million threshold as that got grandfathered in. This would be on new mortgages, the $750,000 limit. The other thing to mention too is it's still applicable to secondary residences. There was talk about only being your primary residence, but you can deduct mortgage interest up to that limit on a secondary as well. The next thing is going to be a big thing for New Yorkers is state income taxes and real estate taxes. That is now going to be capped at $10,000. So in a state as we are here in New York, it's going to make a big impact because we have a lot of income taxes for state purposes. Charitable contributions, that is going to stick around as well. There is a new limitation on cash contributions. It used to be 50% of your adjusted gross income. That's now 60%. Investment interest expense and medical expenses. Medical expenses were on the chopping block, but those did stick around. But you need to be above 7.5% of your adjusted gross income to be able to start deducting your medical expenses. And then one other deduction that's still around is, it's not an itemized deduction, but it's student loan interest. But you need to be careful with that one because there are relatively low income thresholds for student loan interest. So you'll have to determine if you are eligible or not for that deduction. So I mentioned a few of these things just now, but a couple other ideas here. I mentioned the state and local income taxes, that's capped at $10,000. One other thing to mention on the mortgage interest, home equity line of credit used to be able to deduct. That is no longer deductible. So even if you had one in existence before this legislation, you can no longer deduct that home equity indebtedness. Charitable contributions, I mentioned the increase in the percentage limit. One other thing to think about is with the increase in the standard deduction, you'll likely see a lot more people making contributions directly from their IRA and what's called a qualified charitable distribution. You have to be over 70.5 to do this, but what that'll essentially do will reduce your taxable distribution, so you get a benefit for it. And if you were taking the standard deduction going forward, you wouldn't have gotten any benefit for that. Another big one in the bill was alimony. So effective after December 31st of 2018, any divorce or separation agreement that is executed, the alimony that is received will not be taxable, and the alimony that is paid will not be deductible. Having said that, if there's a divorce that is already final and you have been paying alimony or receiving alimony, that will still be applicable. This is for divorces after December 31st of 2018. Another one, exemptions. Exemptions are going away. That was roughly a $4,000 benefit per person, with the exception of if you had made a certain amount of income, those exemptions would get phased out. So the idea there is with the increase in the standard deduction, that the loss of the exemption would help offset some of that, as well as the expanded child tax credit, which I'll get into right now. So the credit used to be $1,000 per child. It is now $2,000 per child. And one of the big things is the phase out for where your income is much greater. So in the past, it used to be a little over 100,000 is when the credit used to get phased out. Now it's 400,000. So there's a lot more taxpayers in that range that will be able to take advantage of this full child tax credit. And the refundable amount went up slightly as well from 17 to 18. Kitti tax, so this will still apply to children that have over $2,100 of unearned income. But the way that it used to work is when you went over $2,100, the income was taxed at the parent's rate. Now it's going to be taxed at the estates and trust rates. And with the estate and trust rates, the tax brackets are very condensed. So once you go over $12,500 of income, you're taxed at the highest rate. So you could see children having to pay more in tax because of this change. Another one that's impacting children is the change to the Section 529 plans. You are now allowed a distribution of up to $10,000 per child to use for qualified expenses, tuition expenses for K through 12. One thing I will mention is New York State has yet to kind of announce what they're planning to do with this. As of right now, they're saying it appears they will not allow that distribution, so you might have to recapture the contributions that were made, but that is still to be seen. But for tuition for colleges and universities, that remains the same. If you incurred 50 grand of tuition expenses, you could take out 50,000 and pay for those. Everyone's favorite, the alternative minimum tax. This one was on the chopping block and stuck around. But having said that, I would expect fewer taxpayers to be subject to the AMT going forward. And the reason I say that is twofold. One, because the amount of taxes that the taxpayer will be able to deduct going forward is very limited, because if you remember, those are capped at $10,000 now. And for AMT purposes, taxes get added back. So if you were subject to the AMT in the past, you weren't really getting any benefit for those taxes that were paid. And the other reason is the phase out income threshold for the exemption for AMT purposes is much higher. So you'll still get the full exemption, and like I said, most likely a lot less people will be subject to the AMT. So a couple examples I just wanted to mention real quick in terms of what this means for a taxpayer. I went through a couple real high level calculations. So an example would be if someone made $100,000 and they itemize, they own a house, have some mortgage interest, it looks like their tax paid will go down some in this situation. And then if you add kids into the equation, it'll benefit them a little bit more just because of the increase in the child tax credit. Having said that, again, it's really a case specific thing. So you don't want to just say, okay, if I make $100,000, my tax is going down. There could be other variables that play into it. And as your income continues to go up, there could be other variables that play a big impact. For example, the AMT. I mean, if you're subject to the AMT in the past and you no longer are, there could be ramifications there where you save more money than you might expect because of AMT issues in the past. So again, it's very facts and circumstances specific. So you want to be able to reach out to your advisor to say, okay, what does this mean for me? And so the next thing I want to hit on real quick is estate planning. Just a few things there. The exemption is going to double from 17 to 18. But having said that, those exemption amounts are expected to sunset after 2025. So some interesting opportunities here for the next few years on that. And the other thing that stuck around with estate planning is the step up in basis for inherited assets. That was potentially going to go away, but that still remains. And then the next slide just goes through the tax rates for trusts and estates. And as I said earlier, the highest bracket starts at $12,500, so you get there pretty quick. And then the last thing I just want to mention before I turn it over to Morgan is with retirement planning, there were talks about severely limiting how much you could defer into your retirement plans, but that was all left alone. So the amount for 2018 is actually $18,500. That went up $500 from 17, so that's how much you can defer. And there's also the $6,000 catch-up if you're 50 or over, and that's stayed the same as where it's been. And then one last thing in terms of Roth IRA conversions. In the past, you used to be able to recharacterize those up until the extended due date of your return, but that is going away. So if you did a conversion in 2017, you still have up until October 15th of this year to recharacterize, but going forward, there's no more recharacterizing Roth conversions. All right, Morgan, I'll turn it over to you.
So I'm going to be talking a little bit about the changes here related to businesses specifically. Before I get too deep into the details, just as a overview, it seems that most of the provisions that have impacted individuals do tend to make the tax filings perhaps a bit easier. What we're finding with the provisions related to businesses is this is probably going to get quite a bit more complicated. So we have that to look forward to. Some of the topics I'm going to cover are going to be corporate rates and the AMT, net operating losses, some other provisions, interest expense, a lot of new stuff. So we'll go ahead and get started. For corporate taxpayers, there's going to be a decrease from the highest tax rate from 35% to 21%. In order to kind of offset the effects of this, they also dropped in an adjustment for the dividends received deduction. It's no longer 70%, now it's 50%. In addition, they've eliminated the corporate AMT, so congratulations to all the corporations out there, no more AMT for you. And they've also made some changes to net operating loss deductions. Going forward, they're going to be limited to 80% of the taxable income without regard to a net operating loss deduction. Any unused net operating losses can be carried forward indefinitely, and they don't need to be carried back. In fact, they can't be carried back anymore. And then I have a note here saying, what about the old ones? What's coming up is right now we don't have any regulations that have been released that explain what's going to be done with the old net operating losses that are being carried forward right now. What we do anticipate is there's probably going to be some kind of complex calculation to determine the change in the limitations to kind of marry the two types of net operating losses together. So more to come on that as regulations start to be released. Other provisional changes, so we get to say goodbye to a few things, one of which is the domestic production activities deduction. That's going bye-bye. That used to benefit manufacturers primarily. It's definitely something that's going to have a big impact on manufacturers. Also, entertainment expenses, for the most part, bye-bye to that deduction as well. There's going to be certain limitations applied to gift cards and other cash gifts that are made to employees. A big one that we're seeing is going to have a huge impact, particularly on real estate industry, is the Section 118 grant income. Basically what that relates to is there's a provision in the law, the old law, that says that if you get a grant from a government agency, if you're a corporation, you don't have to pick it up as income. It's just considered to be a reduction in the cost of the assets that you bought. That goes away. So what it means is if you get a grant from the government, you're picking it up as income. For those people that are in the real estate world, that can have a very damaging effect on your ability to get financing for projects. For all the accountants out there, we're really happy. No more technical terminations of partnerships. That's pretty great. For people who have tax advisors, it's great too, because it means you don't have to pay us to do it. There's also some new things coming into play, changes to research and experimental deductions. They're not going to be currently deductible. They're going to have to be amortized over a period of time. And then there's also an increase to the UNICAP rules, where you're not subject to the UNICAP rules if your gross receipts are in excess of 25 million. So that's pretty great. Next, we're going to talk about depreciation changes. There's new rules related to bonus depreciation. Starting September 27th of 2017, there's going to be allowed a 100% bonus depreciation deduction allowed. It's available now for both new and used short-lived property. So that's property that has a life of 15 years or less. So think land improvements, furniture and fixtures, equipment, items like that. There's also going to be an expansion of Section 179 where the amount that you're allowed to deduct is going to increase significantly. Interest expense limitation. This is a new one in the tax legislation. There was nothing similar to it before. On a very high level, what it's going to mean is that your interest expense deductions are going to be limited to 30% of your adjusted taxable income. I won't go into too much detail on how that's calculated, but a few extra caveats to that rule. If you're a small business, you're not subject to this limitation. And what the law says a small business is a company that has 3-year average gross receipts of less than 25 million. You have to be careful with that one because you have to take into account affiliated groups of entities. What does that mean? It's totally unclear at this point in time. We expect to see some regulations coming out over the summer that are going to describe to us exactly how this limitation is supposed to be applied, but right now it's a bit unclear. You are also not subject to this if you're what's called an electing real property trade or business. The problem with that is if you do make that election, you have to change the way that you depreciate property. So it actually could end up costing you money instead of saving you money. So you have to be careful with that one. Next, we'll talk a little bit about like-kind exchanges. There's no new restrictions on like-kind exchanges of real property. So if you own a building and you want to exchange it for another building, you can certainly still do that. However, they did repeal this same exclusion as it relates to tangible personal property. Tangible personal property is just a fancy term for anything that's not a building. So airplanes is the common one. We see a lot of right now like-kind exchanges for airplanes. That's not going to be allowed anymore. Next, we'll talk about the qualified business income deduction. This one is incredibly complicated. On a very high level basis, you're allowed to take a 20% deduction related to your qualified business income. What that qualified business income is a highly complicated definition. It's income from a business that is not deemed to be service or wages or compensation. The way that gets applied is subject to certain limitations, including it can't be any more than 50% of your wages or 25% of your wages and 2.5% of your tangible property. Really complicated stuff. One of the issues that we're trying to get some clarification on is whether what the definition of wages really means. Is it only your employees, or does it also include contracted employment agency type expenses that you incur? In addition, service industries are not allowed to take this deduction in most cases. Service industries would be things like CPAs, doctors, lawyers, or any business that the IRS is going to come up with a definition of substantially all of the value that you add is from providing service that is related to your ability to do something. We'll have to see what the regulations, whether they dig a little deeper and give us some more clarification. Some service providers are going to be able to take the deduction, but it's subject to very stringent income thresholds. So you may or may not be able to see some benefit from that deduction's availability. That wraps up the topics for today. I wanted to talk a little bit about some more tax provisions that we're going to be talking about coming up soon. We've got a schedule of releases of some additional information that you can see on the slide here. We're going to be targeting some specific impact for professional service providers. We're also going to be looking at the 529 saving plan funds. And we're going to be talking a pretty in-depth article on meals and entertainment expenses and what this tax legislation is going to do to those deductions. So I want to thank everybody for joining us today. Both Kevin and my information is on the current slide. If you'd like to learn a little bit more, you can certainly check out our website, and you can also contact either of us to get more information and talk about these issues.
Thanks for joining us today.